Hi everyone, I'm Darren and I am your everyday financial advisor here to help you on your journey to financial success. Thank you for coming out. Appreciate your time. Today we're going to get into part 2 of risk protection planning, and we're going to discuss the areas of disability insurance and critical illness coverage. Before we get started, I think it's important to recognize that in the perfect world we'd all be able to go out and get all the insurance coverage we need. Life insurance, critical illness, disability, long-term care. But, recognizing the fact that we all live within a budget and we all have limitations on what we can do, the goal is to try to put ourselves in as good a place as possible. So let's start out with disability insurance. If you're one of the lucky people out there, you actually might have group disability coverage through your group protection plan. And that's awesome. It's better than not having any coverage at all. But there are limitations to it, limitations that a lot of people aren't really aware of. So let's start with that. If you have group disability coverage, one of the main things you should recognize is that your coverage really only has a 2-year benefit period. And after that 2 years, if you still need to make a claim, if the insurance carrier sees that you are educated, trained, or experienced at anything else that you can do, then they're going to cut off the coverage. The other kind of key component to group disability coverage where it has some limitations is that it's controlled by your employer. So if you leave that employer, you don't get to take it with you, and you might be in a position where you really need it and don't have anything. So I've always recommended to clients that even if they do have group coverage, it's great to be able to have a personal plan that you can control and you can dictate what you want to have on it. If we're talking about personal plans, we're looking at 3 components that make up the base of the coverage. That's your waiting period, the monthly coverage amount, and the amount of time you want the coverage to last for. So with most companies out there, you can typically choose terms of 2 years, 5 or 10 years, and to age 65. Obviously, age 65 is probably the best option available to most people, but sometimes it can prove a little bit too pricey. The next thing you want to look at is your waiting period. And again, typically we see 30, 60, and 90 days as your main options. 30 days is kind of pricey in comparison to 60 days. And 90 days really doesn't have that big a discount compared to 60. So typically I usually recommend to clients to have a 60-day waiting period on their disability policy, and I like them to have 2 months of income available in an emergency fund. That kind of takes care of your waiting period. The third component is the amount of coverage you want, and there's obviously limitations. It's based on your current income. Typically, you're looking at anywhere between 50 and 60% of what you're making, but that benefit does come to you on a tax-free basis. And that's another advantage of privately owned coverage over group coverage. If your group coverage is paid by your employer, then the benefit becomes taxable to you. So it's something to think about. So those are the 3 main components, and you can price your plan based on you give and take in any of those areas. So obviously a longer waiting period is going to reduce your prices, a smaller monthly benefit, or a smaller benefit term. So let's talk about the actual term that you should be taking for your coverage. The main concern I have with the 2-year benefit period is that if you suffer a disability that lasts longer than 6 months, then statistically your disability is going to last more than 2 years. So I think the advantage of at least a 10-year benefit period, or 5 years in some companies' cases, that's all they offer, is that you have time to make adjustments in your life, whether that means maybe retraining for a different type of job or different occupation. Now, on top of that base coverage, what you can do is you can add certain riders, and there's ones that I really think are important to add to a disability policy that I tend to lead clients towards. So the first one is what we call COLA, or the cost of living allowance. And really what it is if you're on claim, and let's say you're on claim for a long period of time, if your monthly benefits say $4,000, well, 20 years from now, $4,000 is going to buy as much as it does now. So just the power of inflation is going to erode your purchasing power. So I always try to get clients to at least put a 2% cost of living index onto their policy. The other area that I think is really important is in the classification of what you're considered disabled from. All disability policies come with the base, which is all occupations, which basically means after 2 years, again, just like your group plan, anything you're educated, trained, or experienced at, you're expected to do. So if you can flip burgers at McDonald's, they're going to probably cut off your coverage. You can add riders to your policy that protects that definition of occupation. So the best one out there is what we call ONOC, and we see it among people like doctors, lawyers, other professionals, higher income earners. So the example I use is if I'm working with a surgeon and she has an accident or some kind of ailment that damages the nerves in her hands and she can't do surgery anymore. If she has own occupation on her coverage, it means that she can still go out and continue to earn a living, but as long as she's not doing surgery anymore, she'll continue to get her disability benefit. So she could still specialize in a certain field but not do the surgery. So that would be one option. She could just become a general practitioner. She could teach in a medical school. But as long as she's not doing surgery, not only will she continue to get the income that she'd be earning in that other field, but she would continue to get her disability benefit. The one that most people should get is what we call your occupation. What your occupation simply means is as long as you're not earning an income and you're still disabled, as long as you can't do your specific job that you were doing when you got disabled, then you can continue to get your benefits. So beyond that 2-year period. So it's a really important rider to add to your policy. A couple other riders that are kind of important are future income options. If I'm working with a new doctor just graduated from university, medical school, and they know their practice is going to grow over the long term, but they're not earning at their highest potential yet, we typically put on future income option, which allows them to buy more disability coverage as they get older and as their income goes up without having to provide any type of additional medical information. The other option that we see every once in a while is a return of premium option. And this is a good option for those people who look at insurance and say, yeah, but if nothing happens to me, like it's just wasted money. The return of premium option is available with some companies here in Canada. And the way it works is after 7 or 8 years, if you haven't made a claim, you can get a refund of up to 50% of the premiums you've paid. So what it does is it helps those people who really don't like insurance that much but want the coverage. It puts them in a position where they can see some value even if they don't have to make a claim. Now, the other area I wanted to talk about today was critical illness coverage. How critical illness insurance works is if you're diagnosed with one of the recognized illnesses in their definitions, and there's about 48 with most companies out there right now. Big three are cancer, stroke, and heart disease. They make up about 80 to 85% of claims. If you're diagnosed with one of the recognized illnesses and you survive, on average it's 30 days, then you get a lump sum benefit. Then this lump sum of money coming in from the critical illness plan can do things for people like, keep up with current expenses, maybe eliminate debt if that's what they want to do. For some people, it could provide the assets that would allow them to seek alternative treatments or get themselves put on a transplant list in another country. We have great health care here in Canada, but we do have pretty long waiting lists when it comes to certain types of surgeries, and transplants would be one of them. So critical illness insurance might allow you to have the funds that would let you go down to the States and have the surgery down there. So that makes sense to some people. Another big area of concern when it comes to a critical illness, though, is what it does to your projections of your retirement planning. Let's say you do suffer a critical illness, you're out of work for a period of time, maybe you're getting disability benefits, but they're just covering your basic expenses. You're not able to save anymore, and it lasts 2-3 years, let's say. The problem is that 20 or 30 years down the road, that's going to have a big impact on your overall retirement savings. So having critical illness coverage available to you allows you to continue to funnel money into your retirement planning and keep those strategies on track. So with critical illness insurance, you have what we consider your basic coverage. And that could be whatever benefit you want it to be, 100,000, 150,000, 250,000, 500,000. It's whatever number you choose it to be. You're going to have your base costs of that. But you can add riders to these policies that really can make a big difference. Riders I always recommend are cost of living allowance again. And how it works is every year your benefit goes up based on whatever cost of living you purchase. So if it's 2%, it continues to go up. So if you bought your critical illness insurance when you're 30 years old and at 45 you have an incident, that $100,000 policy you originally bought is now maybe worth $150,000 or $160,000 because of that inflation adjustment. The other two riders I like to add are a return of premium on death and return of premium after 15 years or expiry of the contract. Those two riders are actually really great because what ends up happening is, let's say that you suffer a critical illness, you have a heart attack, but you don't survive the 30 days, you pass away 14 days later. If the critical illness policy in that case wouldn't pay out, but if you had the return of premium on death, then your estate gets all the money back that you paid into that policy originally. So it's not a bad way of making sure someone's going to get something from that insurance contract. The return of premium after 15 years or expiry is the other one I like. So it can certainly increase the cost of the contract, but the big advantage to it is that, let's say you're 35 years old, you buy this policy, and at 15 years later you decide, I really don't think I need this anymore. I'm covered in other areas. I have significant investment savings now. I'm not concerned about a critical illness affecting my life as much anymore. You can surrender your contract and you get all the premiums back that you paid in over those 15 years. And if you look at the cost of that rider, let's say that the base cost of the coverage is $700, the rider's another $400. If instead of purchasing the rider, you took $400 a year and invested it, in 15 years, the rate of return you're going to have to earn on that money in order to get all the money back that you've paid into the critical illness contract is going to work out to 9 or 10%. It's really high. So the rider, although it's pricey, has a really great what we call internal rate of return on it. So that rider is 100% guaranteed. So if you chose to invest instead of purchasing the rider, you'd have to invest in a guaranteed type of product in order to make it a comparable rate of return. And you're not going to get 9, 10%. Now, the longer you hold on to the product, that internal rate of return drops, but you're still even 30 years out. The rate of return is typically 5, 6%. So it's really a great add-on if you're one of these people that says, I really don't like insurance. So, what if I don't make a claim? I don't want to waste the money. You can't possibly waste it because someone's going to get something out of that plan. I like to compare disability insurance and critical illness coverage to seat belts and airbags in a car. Let's say you get into a car accident. If you have your seat belt on, even if it's a serious accident, there's a good chance you're going to survive it. And there's even a better chance you're going to survive if not only you have your seatbelt on, but your airbags go off and they're protecting you. But if you're in a serious accident and you don't have your seatbelt on and your airbag doesn't happen to go off, you're going to be in a lot of trouble. And that's why I look at disability insurance as your seatbelt and critical illness as your airbags. And if I have a client that asks me, Darren, which one should I get? I can only afford one. I always lead them towards the disability insurance first because it covers you 24 hours a day, 7 days a week. It covers you no matter what happens to you. If you're disabled from whether it's an injury or a disease, you're going to get your benefit. Whereas critical illness only covers you if you get one of the recognized illnesses. And like I said, 80 to 85% of critical illness claims are for heart disease, strokes, and cancer. And cancer makes up about 50% of those. So if I have a client that only can afford one, I'll lead them towards the disability insurance. Now, if I have a client who has group disability insurance, then normally what I'll suggest is let's top up your group coverage with a little bit of personally owned and get the critical illness coverage at the same time. And typically that works pretty well in most people's budgets. Now, I have met some people who say, well, insurance companies don't like to pay claims. And that's completely wrong. In over 30 years of experience, I've never had a company not pay a claim. But I am going to tell you a couple stories about critical illness plans that did get paid. So the first one was a client who I inherited. I went out to meet. We got talking about their planning. And it came up during the discussion that they did have critical illness insurance. And at that point in time, he mentioned that he had been diagnosed with a form of skin cancer. But his advisor before me had said to him, "Oh, it's not serious enough that they'll pay the claim." I disagreed. My attitude was it absolutely doesn't hurt to make a claim and see what the insurance company says. And after reading up on the type of skin cancer he had, I thought it's a reasonably good chance that they are going to pay the claim. And the insurance company had a look at it, and it only took them about 2 months to decide, yeah, this is actually a claim. And they paid him out $50,000. The other incident was a woman. She was 34 years old. We wrote her up on a $250,000 critical illness policy. And about 3 months after she was issued the policy, she went to her doctor, just her regular routine checkup, and the doctor noticed a lump on her breast. It was cancerous. They went in and removed it. It was fairly significant. And we made a claim based on the fact that she had breast cancer. The insurance company did their due diligence. They wrote to the doctors. They wanted to see all the reports. But it was less than 3 months later that they came back with a check for $250,000. So don't get fooled into thinking that insurance companies don't pay their claims. They wouldn't be in business if they didn't, and they do. The takeaway from today, again, comes down to having your professional, your financial advisor, your insurance advisor sit down with you, go over a needs analysis, find out what problems you have, if any, and put together some solutions, and then work those solutions into your budget. So thanks again for coming out. As always, please, if you haven't already done so, subscribe, refer me on to friends, and hit that like button and make some comments. I'd like to hear from you. If there's subjects you'd like me to talk about, please let me know, because I'll be happy to put something together for you. Take care and have a great week.